In this video, I compare two popular Vanguard ETFs, which are VTI and VOO. There are many funds out there with better returns than VTI or VOO, but these two fantastic ETFs are just like rice and beans. Yes, they are boring, but they are reliable. You know exactly what you're getting with them, just like with bread and butter. VTI and VOO are very similar when it comes to performance, but in the last 5 years they began to slightly diverge. And that's an interesting observation worth exploring further. This will likely decide which fund is better for your portfolio. Both funds come at a rock-bottom 0.03% fee, which is incredibly low by fund management standards. There are many funds out there promising higher returns at a higher fee, and even a slightly higher fee, like by 0.2%, can snowball into a big difference in terms of performance. So I'm always watchful of what kind of fees a given fund charges, and it's good to know that both VTI and VOO are extremely cheap. Next, let's understand how these funds work. No doubt you heard about S&P 500, but there are several details that even I personally didn't know about. There are reasons why it's so hard to beat S&P 500. Its design and construction plays a crucial role there. S&P 500 tracks the performance of 500 largest companies by market capitalization. Before making it into the index, each stock must jump through a set of hoops. The index committee weeds out companies based on market cap, profitability, and liquidity. Profitability is probably the biggest hurdle for any given stock to clear. If a company has not turned a profit in a given year, it is out of luck and must remain on the sidelines. For instance, it took a while for Uber to make it into the S&P 500. Despite its large market cap, Uber turned a profit only in 2023, and that's when it made into the S&P 500. Some people point out that this committee-based selection lacks clarity, but there are pros to that. It adds some flexibility that can reduce unneeded churn when the index is reconstituted, and this can in turn reduce transaction costs for funds that are tracking S&P 500. Also, the S&P 500 weights its holdings by market capitalization, and this allows the index to augment the market's collective wisdom when it comes to relative value of large cap stocks. Such approach favors relative performance by amplifying strong returns and suppressing weak ones. In other words, if the market cap of a given stock starts to decline or stagnates relative to its peers, the S&P 500 will allocate less to that stock. Simple? Yes, but deadly effective. Since 2015, S&P 500 booted out 180 stocks and replaced them with something else. And that's a whopping 1/3 of the entire index. It's not exactly surprising. This turnover basically just reflects the fast-changing pace of the US economy. As new, faster-growing players emerge, they eventually overtake old-timers. As for VTI, it tracks the performance of the CRSP US Total Market Index. This index covers the entire investable US stock market. VTI invests in stocks with at least $15 million in market cap. Also, the fund applies certain liquidity requirements. After that, VTI weights its holdings by float-adjusted market cap. S&P 500 stocks cover over 80% of the entire US equity market, and the remainder is just in mid and small cap stocks. So this is where the differences between VOO and VTI emerge. While by its design VTI will include those remaining stocks, VOO excludes them. If we compare market cap allocations, VOO has almost no allocation to small or micro stocks. We will come back to this difference in a second. As we will see, this probably caused a recent divergence in returns between the two funds. When it comes to sector allocations, VTI and VOO are very similar. But as we see, small differences emerge here and there. For instance, there are many more mega-cap stocks in the tech sector with trillions in market cap. VOO allocates slightly more to these stocks compared to VTI. This reflects the fact that VTI covers all investable stocks as opposed to only 500 largest equities. Both funds go heavy on tech, which may make some investors worry, but that's not the fault of VOO or VTI. They only reflect the market's composition and where money flows based on profits and growth. Right now it's tech. Decades ago it was industrial and financial stocks that dominated the investable landscape. As new winners emerge, both VOO and VTI will reconstitute and capture them in their portfolios. Looking at the top 10 holdings, they are identical, but VOO allocates more to these trillion-dollar stocks by its design. At the same time, VTI's top 10 holdings have less concentration at 30% compared to VOO's 34%. What's interesting is that this top heaviness has not always been the case. For instance, in 2015, VOO's top 10 holdings had 17% allocation. But as large stocks eclipsed the rest of the stock market, concentration has doubled since then. Same thing happened to VTI. If we look at fund overlap, we see that 88% of VTI and VOO coincide. Given that 500 large-cap stocks account for a large chunk of the US stock market, that's to be expected. Now, let's review the performance of these two ETFs. Because their index funds, VOO and VTI, remain fully vested, and their cash position is almost always minimal. For this reason, these two funds will follow the ups and downs of the US stock market. The earliest we can compare VOO and VTI is 2010, when both funds were trading. The funds showed a pretty similar total returns profile up to about 2021. After that, VOO began diverging and outperformed VTI, even if slightly so. Why is that? We can trace the reason to the absence of small-cap stocks in the S&P 500. If you ask around, there's some debate about holding small-cap stocks. There's some analysts that swear by them and uncover hidden gems that are multi-bagger stocks. But at the same time, there are many small-cap stocks that just sit for years and do nothing due to little institutional attention and love they get. Let's take a look at the performance of large-cap stocks relative to small-cap ones. When this graph value rises here, large-cap stocks outperform small caps and vice versa. For instance, when the dot-com bubble happened in the late 1990s, large-cap stocks did better. But after the bubble burst, the small caps took some of that ground back. From 2010 to 2020, the relative performance of large versus small caps was more or less in balance. But during the COVID recession, small cap stocks got hammered, while large caps did better. We can see this from this peak on the graph. Afterwards, small cap stocks did much better on rebound. We can see this from this dip. Many analysts point out that when times are bad, the large cap stocks tend to do better. And that's because they're big players with ample capital and ability to cut costs when times are not good. But when the economic expansion follows, small caps tend to do better. And that's because after the steep sell-offs, small caps have more room to recover and enjoy economic upturn. But after a brief pause in 2020, large caps continued doing better than small caps. The evidence of that is the upward growing trend on this graph. You may wonder why it took this long to discuss small versus large cap stocks. The thing is that depending on what happens in the future, VTI will either under or outperform VOO. For instance, over the last 5 years, VOO did better than VTI. No small cap exposure and high allocation to large cap stocks is behind it. As market cap for Nvidia, Microsoft, Apple and others exploded, so did VOO. This feature is of course not exactly riskless and comes with one shortcoming. If large caps underperform for some reason, VTI may do slightly better than VOO. Then there's volatility to consider. Let's take a look at Sharpe ratios. The numbers are consistently better for VOO. In other words, VTI is either more volatile or has a slightly lower returns, especially lately. Is this surprising? Well, VTI's exposure to small cap, high beta stocks increases its volatility, even if slightly so. The main question is, does the higher Sharpe ratio for VOO make it a clear winner? If you watched any of my videos on ETFs or risk, you probably know that I'm not a big fan of risk-adjusted returns. And the reason is because, true, they're helpful, but they should be looked at in the context of what's the true meaning of investment risk. Permanent loss of capital is rare with well-diversified funds like VOO or VTI. In the big scheme of things, slightly higher volatility for VTI doesn't mean anything in the long run. Instead, I personally would focus on total returns and understanding where small caps versus large caps will go from here. Plus, we should not forget that what we're looking at here is historical performance. Okay, so let's summarize what we've seen so far here. The goal is to understand why would an investor prefer VOO over VTI or vice versa. VOO provides best-in-class exposure to large-cap stocks with a blend of value and growth. Conversely, VTI takes a look at the whole investable US equity market. This makes it a one-stop fund for most investors. With that, a few consequences follow. VOO provides no exposure to small caps, while VTI does some at about 10%. Investors who expect large-cap stocks to outperform small caps can safely ignore VTI. VOO could be a better choice in that case. But small-cap stocks can outperform their large-cap counterparts on occasion. This has happened before, like it did at the end of 2020. In that case, VTI could be a better choice. In conclusion, you can't go wrong with any of these two solid ETFs. They can be perfect as a core building block for anyone's portfolio. Most of the time, their performance will be a mirror image of each other, but sometimes small caps can stage an unexpected rally. Then the performance of VOO and VTI may diverge here and there. What do you think, guys, about these two funds? Do you have them in your portfolio? And how do you allocate money to either of them versus everything else? Let me know your thoughts down below. And with that, thanks for watching. Like and subscribe to my channel for more content on investing and ETFs in the future. And I will see you next time. All the best.